The fallacies of technical indicators. I must have spent years chasing failed technical indicator systems before I finally cleared my charts of all the junk and relied on price alone. The truth is that most indicators are lagging. They follow price but with a delay. Because they get you into a move late, they actually destroy your risk reward and lead to poor trading results. Let's look at some examples. The moving average crossover is probably the most widely known trading strategy by the general public. It's documented in literally thousands of technical analysis books and mentioned countless times on mainstream financial media. Yet it's fundamentally flawed in today's markets. The main problem is it's a reactive rather than predictive way of trading. The method assumes that momentum will continue after a crossover with no thought to the current conditions of the market. Probably the most famous of the crossovers are the death cross and the golden cross. You sell when the death cross occurs, which is a 50-day moving average crossing down below the 200 moving average, and you buy when the golden cross occurs, which is a 50-day moving average crossing up above the 200 moving average. So what does this look like on a chart? Well, you can see on this chart that I've plotted where the 50-day moving average has crossed the 200 using the yellow dots, and this would have given you a signal to enter. Now, on first impressions, this looks great, but if you project where you would have actually entered the market using these yellow lines and where the red dots are, you can see that it gets you in almost when the move is over, or midway through the move, or even when the move is just about to reverse. Now let's compare this to entering at a supply-demand zone. Basically, supply and demand zones will get you in at the turning point rather than too late, like moving average crossovers. Now don't worry if you don't understand this diagram straight away, we're going to be covering all of this later in the course. Another use of standard indicators is to measure what is termed as divergence. This measures the strength of two or more price swings with an indicator such as stochastics, MACD or CCI. In the highlighted section, price makes a higher high, but the indicator does not. This is what's known as bearish divergence. On this slide, price makes a lower low, but the indicator doesn't. This is known as bullish divergence. Theoretically, divergence marks turning points in the market. However, you are about to see that divergence is a common trap that leads to traders blowing accounts. Okay, so I've got a 60-minute S&P chart here, and I've put a CCI indicator on, which can be used to measure divergence. Now, this is a ranging market, and here's a circumstance where it will work. So I'm going to get an arrow line, and I'll show you that we have a low here and a lower low. And the divergence indicator did in fact make a higher low, which signifies that it could go up, and indeed it did. We have another example over here, a low and a lower low, and the CCI didn't make a lower low, and indeed the market went up. Now that's all very well and good, but I'm going to show you another example where you end up grinding down your account using these indicators. Okay, so now I've got the 15-minute S&P chart up in a different location, and I've deliberately working up the right edge here so we can't see what's going to happen. Now you can see that we had a low and then price made a lower low, but the indicator didn't. So I'm going to put some arrows there. So we had a lower low here, and the indicator didn't. Now we may buy here, and what happens? It just carries on down. So let's move along a little bit more. We've made a low here. Now, we've made a low here, and we've made a lower low over here, but the indicator hasn't. which would be another indication to buy. So let's just put some lines in here. So that's your lower low. And in this one, the indicator hasn't. So you may decide to buy here, especially as there was also a bit of a rejection. So let's scroll along. And it continues down again. Move along a bit further. Okay, so we've got a low, price consolidates, makes another low, like that. And the indicator is not following, which would indicate that it should go up. And of course, price continues down. And you can see what happens is that the indicator then follows afterwards. So this can be very deceiving. Let's see if it happens again. Okay, we've got another example over here. So we have our swing low. Price makes another low, but the indicator doesn't. So let's draw some arrows here. And the indicator is divergent, so we think it could go up. We may buy here. And, well, surprise, surprise, price continues down. Anyway, I hope that's helped, and we'll move on to the next session.